at effect of taxation, right? Effects of taxation, taxation on NPV cash flow statement, on NPV, right? So that is what we want to look at. So the most important thing, or point number one, is to note that tax has got two effects, right? Tax has two effects because we have two sides of our NPV cash flow statement. So our taxation has two effects. All right. Effect number one, we have negative effect. Negative effect. Negative effect on operating cash flows. Operating cash flows. So, right. This is what we call tax payable. So, negative effect is tax payable. Tax payable. Right? Tax payable. That's number one. And tax can arise. We can pay tax in the same year or in arrears. Taxation can be paid in the same year or in arrears. So these guys, all right. Let me just, taxation can be paid. Taxation can be paid in the same year, right? Same year or arrears. That is very key and very important. And what does same year mean? If we are doing questions and we are told that taxation is payable in the same year, this means that same year, um, tax taxation starts in year one. Right. If you are told that tax is paid in the same year or in the year where your cash flows arise, or when your cash flows arise, it means that you start paying your taxation in year one going forward. All right. So cash flows for year one are going to be taxed in year one. Cash flows for year two, taxed in year two, and so forth. Arrears. Arrears. If we are paying taxation in arrears, zvinoreva kuti taxation starts in year two. What does that mean? If you are paying in year two, it means that cash flows in year one are going to be taxed. We are going to pay that tax in year two. That is very important. So what is the formula now when we are looking at the negative tax? So we are going to have taxation is equal to cash flow, operating cash flow, the operating cash flow that we have, cash flow, right, times negative tax rate. Let me write that negative tax rate. That is what we do in order for us to find our taxation. Probably I may give a small example so that we can understand this. All right, let's just have a small example here. Example, when we have operating cash flows, given below, okay, tax rate is 30%, 30% in arrears, tax rate 30% payable in arrears, So that is what we need to extract from any question we just need to identify our operating cash flows, tax rate, and timing, because timing is very important. Let's have year 1, 2, 3, probably up to 4. Year 0, 1, 2, 3, 4. Right. Our cash flows, operating cash flow here, operating cash flow. So our operating cash flows, let me just do this so that it's fully visible. All right, again. All right, I think if we can do this, we are now able to see and trace. All right. Okay, our operating cash flows, assuming we have 300,000, 1, 2, 3. We have 250, 1, 2, 3. 1,000. We have 170, 1, 2, 3. And in year 4, we have 284,000. Right, these are the cash flows that we have in terms of the upper side when we have operated. Okay, so if we are now paying taxation, this is how we now pay tax. Since tax is in arrears, means that taxation is going to arise in year 2. Our first payment is year 2. So I want to pay tax corresponding to year 1, but the payment is done in year 2, minus 30% times this tax rate in year 1, and I drag to year 5. If my tax is in arrears, it means that I am going to add an additional year at the end, which is year 5. So this taxation is tax on operating cash flows, and it is negative. So what is key? Key is to note that timing on cash flows is very, very important. So timing is very important when we are dealing with taxation. So far, so good. Do we have any question? Any questions so far? Yes, friends. Any question? All right. I hope understanding. I hope you are understanding. Okay. Right. Let us look at the positive effect. We have looked at the negative effect, and this is going to be applicable on operating cash flows. Right. Let us look at the other effect, which is number 2, positive effect on initial investment. So when you invest into a project, you are going to be given an allowance. So this is going to be an allowance in terms of your tax payable is going to reduce by a certain amount, but that amount is calculated based on your initial investment amount. Positive effect on initial investment amount. So this amount is the one that we are going to use. So this is a capital allowance. Calculated using the initial amount invested, right? So it is called right, capital allowance. We can call it capital allowance or tax allowable depreciation. right? Tax allowable depreciation or the capital allowance. That is what we call it. So how do we calculate it? Right, since this is a benefit, it is a benefit to us. So always positive. Okay, positive. We treat it positive, right? We treat it as a cash inflow. A positive cash flow is a cash inflow. How then do we calculate the tax allowable depreciation formula? TAD for tax allowable depreciation is equal to depreciation amount multiplied by tax rates. So that is what we do. So this is how we can also calculate the TAD, which is positive. And this one, we are going to put it on the investment side. Remember last time we tried to break our NPV cash flow statement into two components: the upper side, which is REVEX, revenue expenditure, and the lower side, which is the capital expenditure side. So falls under the capital expenditure side, right? So in order for us to comprehend this or understand this better, let us have a simple example here so that we can calculate TAD together. Example, another example for TAD, right? The initial invested amount, for example, a project, let's have a project with whose lifespan, with a lifespan of 4 years, requires an initial investment of 320,000 scrap value at the end of year 4 is $50,000. So scrap is the amount which we can actually trade in with our machine at the end of the project. So this is a cash inflow, right? Tax allowable depreciation, is available at 25% reducing balance. All right, depreciation. All right, tax allowable depreciation is available at 25% reducing balance depreciation method. All right, this is how we are going to claim our TAD. All right, corporation tax is 30%. Is 30% payable in arrears. All right, so this is what we have. From this piece of information now, we want to calculate our tax allowable depreciation using what we have here. So our project has 4 years. That is key to note. Of course, the project is 4 years. Here is 4 years. That is the project's life. But our tax is in arrears. So it means that our years, we are going to claim the final benefit in year 5. So it then probes us to have 5 years, 0, 1, 2, 3, 4, up to year number 5. This is what we do. All right. Hopefully, guys, you are following so that we move together. I have my 5 years here. Now, first thing is for me to put my initial investment amount. So this initial, I may not really write initial because after depreciation, it's going to be net book value. So it's cost or net book value. I would rather write WDA. What does WDA mean? WDA is written down amount. Okay, written down amount. So others would want to call it WDV, which is written down value, which is okay. All right. In year 0, I'm going to make an investment of 320,000. 320,000 here. That is my initial investment in year 0. Okay. And I have to calculate my depreciation at 25%. And this is a reducing balance basis. Our depreciation, a machine or an asset, is depreciated only after 12 months of purchase. So it's year 1. We do not depreciate our asset in year 0. We start depreciating in year 1. So 25%, 25% times this amount is my depreciation in year 1. After depreciating my asset, I want to see the net book value. The written down amount is initial minus the current depreciation. All right. I go again in year 2. I calculate 25% times this written down amount. I have this one. So for me to get my WDA, this minus that, I get this one. I go to year 3, I do the same, equals 25% times this amount. I have it here. And I remove 45,000 from my machine. I have 135,000, right? So far, so good. Let me know, guys, if you are able to follow through this so that I explain now where we are going to.
Yes, we are following.
Thank you. So if you are following,
Following.
that's good. Please just unmute yourself and say something if you are left behind. Now, let us have a few notes. So my project is ending in year 4. Let me highlight year 4 here so that it's key, it's critical, right? So note number 1, I am going to write a note to say, do not calculate, all right? Or rather, if I say that for WDA, right? For WDA in the final year, just take 1 from the preceding year. All right, so we don't calculate WDA the way we calculated from year 1 up to year 3, but what we do in the final year, we are going to take the one that we have in year 3. So since our project has got 4 years, I would anticipate year 3 and 4 to have the same amount. If we had a project with 7 years, year 6 and 7 would carry the same amount. We do this because our machine has got a scrap value of 50,000, and this is how we then balance of for tax purposes. So I'm going to take 135 into year 4, and then for depreciation now in year 4, right? Depreciation in the final year, in the final, that is final year, is replaced by the difference between WDA and scrap amount. So for the final year, we are not going to calculate any depreciation. We are going to do this equals this WDA minus 50,000, 1, 2, 3. This is how we are going to calculate our depreciation, right? Is this followable for my friends? Please let me know. Are you able to follow through this?
Yes, sir.
Ara?
Yes, sir.
All right. That's okay. If you're able to follow through, that's okay. Next item now is for us. Okay, just hold on a bit. All right, that's okay. Right. The next item now is for us to calculate the TAD. So TAD is calculated based on tax rate, 30% tax rate. Our tax is in arrears, so equals 30% times my depreciation amount in year 1. I put in year 2, I drag up to year 5. So this is the TAD component that I'm going to include in my NPV computations. So this one that I've highlighted here is my TAD that I'm going to include in my NPV computation. All right, let me have a question. Effect of taxation is done. Any question from your end? Any questions so that we move to the next item? Waiting for questions.
Say if the tax is payable in advance, we start calculating in year 1.
There is nothing like that. We do not have tax that is payable in advance. So the issue of tax is that you have to realize profit so that you can calculate the tax amount. All right. So it's either your tax is in the same year or in arrears. We do not have tax in advance here. Right. So our
Okay,
taxation is going
understood.
to be same year, which is year 1, arrears year 2. Okay.
Yeah, understood.
All right. That's it. We do not pay taxation in advance. Advance could mean year 0. So we don't start off in year 0. We don't start off by paying taxation. Okay. Whatever that is called in advance starts from year 0. You understand?
Yes, yes, understood.
Okay, thank you. Right. Let us look now to on the next item that we have. We have what? We have taxation. Now let us look at effects of inflation. Right. Let's look at effects of inflation. Right. Inflation. Right. Since we want to invest into a project, there is no economy without inflation. So as accountants or as financial managers, we should be able to incorporate inflation into our investment appraisal. How do we incorporate inflation? So the challenge with inflation is that money is going to lose value. All right. And we have to incorporate that. So we are going to look at two types of inflation, that is real and nominal. So let's have here, I'm going to try and have two sides here, real or current price real inflation. So we call it real inflation or current price terms. Current price terms. Anything that is in real terms or current price terms. What does that mean? It means that cash flows or the discount factor not inflated. There is no inflation if you have a cash flow in real terms or in current terms. It means that there is no inflation. Cash flow, right? Cash flow as it is, right? As is, no inflation. And then the discount factor, or the cost of capital is just interest, right? Without inflation. So you have interest, but the interest also needs to take into account the inflation. So the formula there for a real rate normally it is given as follows: 1 plus I. So real rate is just 1 plus I representing interest. I is interest on borrowed funds. So our money that we have borrowed, the interest that has been charged is that one. Now, if we look at the nominal, we have nominal or money rate, right? Nominal or money rates, what does that mean? It means that the cash flows or discount factor have been inflated. So if it's very key for you to check on your cash flows that you're given, whether they are in nominal terms or they are in real terms, so that you know how to treat, or you know the way forward. Okay, so let us look now. In most cases, what happens is that for your questions, you will get items in real terms, but you are then required to calculate your net present value in nominal terms or in money terms. So let's see how best we can change, or how to inflate cash flows and discount factors. All right, cash flows and discount factors. In other words, we are converting our cash flows and discount factors from real to nominal. Okay, right, from real to nominal, right? Whatever it is, we need to move it from the real terms to nominal terms, from real to nominal. Okay, that is okay. Let us start off by looking at cash flows. How to inflate. Number one, cash flow. If it is a cash flow, how do we inflate them? Cash flows. All right. Inflated using specific rates of inflation. What does that mean? What is a specific rate of inflation? A specific rate of inflation occurs when cash flows are inflating at different levels. All right, so if we have our cash flows inflating at different levels, we call them specific rate of inflation. I want to give an example. Assuming that we have the selling price um, at 6%, and then we have variable costs at 5%, right? We have fixed costs. For example, fixed costs at 4.5%. What does that mean? It means that if you can check our fixed cost, variable cost, selling price, do we have different rates of inflation? So we call them specific. So if we want to inflate our sales or the selling price, we are going to inflate it at 6%, the variable cost at 5%, fixed cost at 4.5%. This is what we call specific rates of inflation. Okay, so how do we then inflate? We are going to have nominal cash flow is equal to real cash flow times, open bracket, 1 plus inflation rate to the power n day. All right, so our specific rate of inflation 6%. So 1 plus inflation rate. Here, let me give an example here. If we are to inflate our selling price, we are going to have our cash flow. For example, we are going to have cash flow, right, times, open bracket, 1.06 to the power n. What does n mean? N represent the year in which the cash flow is arising. If the cash flow is arising in year 1, it is to the power 1. If a cash flow is arising in year 2, it is to the power 2. All right. I want us to have an example on inflating the cash flows using the specific rates of inflation. All right. The following rates of inflation, right? I'm going to just take the ones that we have here. We have selling price 6%, variable cost 5%, and then fixed cost 4.5%. All right, the following cash flows, the following prices, the following selling prices and costs in current terms. All right, selling price is equal to $500 per year, right, per unit for each year. All right, and then we have variable cost per unit. Cost per unit is equal to $180 per unit each year. Our fixed costs, total fixed costs, usually we don't have fixed cost per unit. The fixed cost that we usually have are budgeted fixed costs for the whole project. That's why we have them in total there. our fixed costs, total fixed costs, right, 150,000, right, per year. That is what we have. So from this, assuming, let us just assume, let's assume a project with 4 years, right? Let's just assume a project with 4 years. And how are we going to inflate our prices and costs here? So this is what I'm going to have. All right, I'm going to show it as a working. Probably working number 1, I have nominal values. So my nominal values of selling prices, variable cost, and fixed cost. Let me put my year 0, 1, 2, 3, 4. I have my 4 years here. Right. So what I want to do is, first of all, I want to inflate my selling price. Since the selling price inflation rate is 6%, and price without inflation is $500. So let's do that. Selling price, right? This is the selling price per unit. My selling price per unit is equal to $500, the one with 10 multiplied by open bracket 1 plus 6%, I get 1.06. So I'm going to have 500 multiplied by 1.06 to the power 1 for year 1. So 1.06 to the power 1 times the price. I'm going to have this one, which is 530. I go to year 2. So once you've done that, you can just drag. You can't then drag after you type manually your year. So you don't have to type your year manually. You just need to reference where the year is. And when I drag to year 4, I'm going to have these nominal values. So for my selling prices per year, the selling price per unit per year are the ones that I have inflated here. These are going to be my selling prices. I do the same for variable costs. Variable cost per unit. So I'm going to inflate my variable cost at 5% now, which is specific, equals $180 times open bracket 1.05 to the power. Shift 6 is your power. I click year 1 to the power 1, close, and then I have my year 1 variable cost. If I move to year 2, you can see that it is picking 2 automatically. If I move to year 3, it is picking 3 automatically. If I move to year 4, it is picking 4 automatically. So these are going to be my focus variable cost per unit per year. All right, I'm done with this one. I'm going to also I'm going to inflate my fixed cost. So fixed cost, right, the fixed cost in total equals 150,123,000 times 1.045, because that's 4.5% to the power 1, close. This is now my fixed cost per unit. All right, I'm going to do this. So I have done inflation when it comes to my my variables. So a specific rate of inflation occurs when your variables, rather, when your cash flows are inflating at different rates. This is when we have specific rate of inflation. With some cases, we might not have specific rates, but rather having all cash flows inflating at the same rate. We just do the same using that same rate. There is no problem. Okay. All right, let me have a question from your end. Any question, guys? I'm done with inflating my cash flows. Now we want to look at a discount factor. Yes, go ahead.
Hello,
Thank you.
hello, sir.
Yes, I'm here.
Yeah, on this part, uh, I understood this part, but when it comes to taxation, especially that part where we applied taxation to the initial outlay of the project.
What is the problem there? So you can't just leave me to go and go and go and you don't ask
Okay, so
to ask. Whilst when I conclude
my,
the part, asking you there.
my issue was to say that that one is the standardized way of calculating tax, or I was also considering if maybe I'm in an examination, maybe there's need for tax adjustment. I applied these taxation principles to say, like from year one, two, three, I understood the way, but the final year, which is year four, we said 135, we are now deducting the scrap value. I was considering maybe we shall test for recoupment is to compare the ITV versus the scrap value as the proceed we are likely to get from the disposal of that machine after the project comes to an end. So I just wanted to hear, maybe I'm in an examination, maybe I have not passed through the method of deduction, but I applied maybe the Zimtex to test for potential recoupment and take recoupment as a cash flow. I don't know what is your pertaining to this.
All right. Thank you so much for your question. What happens is that I'm not so sure which level are you doing, but specifically for those who are doing F9, this is the standard way of calculating your tax. Well, I'm going to show you another way as well, another alternative way of you incorporating the tax allowable depreciation in your cash flows, not doing it separately. Yes, of course, it is true that in some cases you have the scrap, but when you dispose of your scrap, you are going to be taxed again. But that is going to be examined at the AFM level, not the F9 level. That is correct.
Okay, thank you, sir. It's a AFM.
Yes, you are doing AFM.
Yes, sir.
Yes, that is key, and it's critical that in most cases now, when you have your project running at the end of the project, you are going to be taxed on your scrap value. So what is key, even if that is the case, there is no problem with this line. Okay.
Okay.
So what you can do actually is that probably let me come here and say you have what? You have your your scrap that is going to be taxed separately. So you can just have your scrap, for example, scrap value, right? Scrap value, you have 50,000 in final year, right? Tax on scrap. So this one, you can actually do it on your NPV, tax on scrap. So that scrap now is going to be taxed in areas that is going to be minus 30% times this. So you might have, after doing everything, you might have these two lines separately.
Okay, okay. Thank you, sir.
You're welcome. All right. Continuation, guys. Let us look at how to incorporate, how to then incorporate inflation on a discount factor. All right. Um, inflating the discount factor. Inflating the discount factor. So your discount factor is cost of capital. All right, cost of K. So your cost of capital also needs to be inflated from real to nominal. So what does that mean? It means that your real cash flow, your real discount factor, the formula for real, right? Let me just go there. Real to nominal, all right, a nominal discount factor. So this is what we do. We are going to have nominal is equal to 1 plus I multiplied by 1 plus H minus 1. All right, so 1 plus I multiplied by 1 plus H minus 1. What is I? I is interest on borrowings. Okay, and then H is general or average inflation. All right, general or average inflation. So what does that mean? Since the discount factor is going to discount all these three variables, so it's not fair for us to inflate with 6%, to inflate with 5% or 4.5%, but rather we are going to inflate our discount factor using the general or the average as given. So if the examiner requires you to inflate your discount factor, they are supposed to give you the general or the average rate of inflation. So no one is going to tell you that use general inflation to inflate the nominal, to inflate your discount factor. You just need to know this. So this is what you are supposed to be knowing. Assuming that we have real cost of capital as an example here. Example that we want to have real cost of capital is 8.6%, and the average rate and the general or average rate of inflation is 4.7%. Right, so what is the nominal discount factor? So for me to calculate my nominal discount factor is to do this. Okay, is equal to, open bracket, my real cost of capital 1 plus 8.6%, close, multiplied by, open another bracket, 1 plus 4.7%, close, minus 1. So I am going to discount my cash flows using this percentage, which is 13.7%. There is no harm. Your examiner allows you to always round. So you realize that one student will use 13.7% and get an answer. Another student will use 14% as a discount factor, which is also okay. All right. So that is the case. Assuming that your discount rates, you want to make use of the NPV table, you will not find 13.7%, but you can only find 14%. But unless if you want to calculate your discount factors using your Excel, yes, you can still go ahead and use 13.7%. The answer that you get is an accurate answer. The answer that you get with 14% is also an accurate answer. We are going to treat the difference as a marginal difference, which does not matter anyway. All right. This is how we treat inflation. Any question before I just give you 2 or 3 lines to conclude this? Any question? Any question? Any question, my friends? No question, I assume. Right. What is the key? Key now. Key is to understand the question. Right. Understand whether you are required to calculate NPV in nominal terms or real terms. So it's not always the case that the question requires you to calculate in nominal terms. Sometimes the question might require you to calculate in real terms. If in nominal terms, right, inflate everything, inflate everything. All right. If in nominal terms, inflate everything. If in real terms, do not inflate anything. Right. So what does that mean? It means that you are going to discount your cash flows, your real cash flows, using the real cost of capital. But this one only works if all cash flows are inflating at the same rate. Only works if all cash flows are inflating at the same rate. Okay, so if assuming that you have been given real cash flows, you have also been given the rates of inflation, and the examiner asks you to calculate NPV. Please assume that you are going to calculate your NPV in nominal terms. This is done, my friends. I'm now waiting for questions so that I can give clarity to this. All right. Any question? All right. Let us move on to the next item. And the item that we want to be looking at is what? Let us look at the next item. We want to look at what we call relevant cash flows. So let us look at relevant cash flows. How do we incorporate relevant cash flows? How are we going to determine the relevant cash flows? All right, relevant cash flows. So first of all, we need to define what a relevant cash flow is and what are the cash flows to include or cash flows to exclude. Right, these are cash flows, right? Cash flows affected by a decision. All right, so the decision to invest, if it affects cash flow, if a cash flow comes into existence due to us making a decision, we call it a cash flow. So we need now to differentiate a relevant cash flow from a non-relevant cash flow. Okay. So let's have two sides. I'm going to have this side here where I'm going to have relevant cash flow and non-relevant cash flow. Guys, is this visible enough? Is my presentation visible enough?
Yes, sir.
All right. If you happen not to see, please let me know. Right, so let me just try and separate these two things here. So I am going to have my relevant cash flows here. I'm going to have relevant cash flows to my left, non-relevant cash flows to my right. What is relevant and what is not relevant, okay? Right. So whenever we are investing, it's not every cash flow that you're given that you are supposed to include in your appraisal decision. All right. Some cash flows are supposed to be ignored. Let me just put a separator here. So for an item or for a cash flow to be relevant, it has to be futuristic. So a futuristic cash flow is relevant. Anything that is past, so past costs, our past costs, we call them sunk costs. The sunk costs are not relevant in decision making. When we are praising a project, please identify those costs that we've incurred already. We are not going back to yesterday to undo our actions, but rather it is gone. We don't have to consider them anymore. Number two, they should be cash items. They are supposed to be cash items. Now, here we should exclude non-cash items. All right, non-cash items, mainly we call them notional costs. The notional costs, right? What are the notional costs? A good example could be depreciation itself. So depreciation, I'm going to tell you the treatment of depreciation. If you want to um, make use of depreciation, that's okay, but you have to remove it. Depreciation is only included for the for tax purposes. That's why we are going to calculate the tax allowable depreciation separately. All right, depreciation, profit or loss on disposal, right? We don't include the accounting profit, right? Accounting profits, right? We don't include them here. They are non-accounting profits arise due to non-cash items. We can also include the revaluation surplus or deficit there. They are not relevant since they are non-cash items. Right. Number three, we should include avoidable costs, right? Avoidable costs, right? Here, non-avoidable costs are not relevant. Number three there, non-avoidable costs. Costs. So avoidable costs are the costs that you can avoid by not making a decision. Non-avoidable costs are costs that whether you make a decision or not, you are still going to incur that cost. Let us have examples here, right? Examples, we are going to have all variable costs. They are relevant, right? All variable costs. We have specific or incremental fixed costs. They are relevant. We are going to have differential costs, right? Differential costs, they are relevant here. All right. If we go to non-avoidable costs, we have the general or apportioned costs. So if you have general or apportioned fixed costs, they are not relevant. So in most cases, you are going to be given, for example, you are going to be given a bunched cost of a bunched amount of fixed costs. For example, fixed costs, all right, are 2 million each year. All right, 2 million each year of the fixed cost amount, right? Only 45% is incremental or specific. What does that mean? It means that at the organization, we might have a total of 2 million fixed costs, but 45% of the 2 million is specifically linked to the decision of us investing. So our relevant fixed cost there could be 45% times 2 million. So in our appraisal, we are going to include 900,000 and not the whole amount of 2 million. Right, that is just an example here. All right. Let us look at another item that is not relevant. Number 4, we have committed costs. So if we have committed costs, so a committed cost does not change whether we have made a decision or not. If we have committed ourselves to paying of those costs, we are supposed to exclude them from the investment appraisal decision. All right, I hope you guys understand. All right, now we have something that is relevant here. Always opportunity cost is relevant. Opportunity cost is always relevant. So how do you define opportunity cost? This is the value of the best alternative forgone in order to pursue another option. So how are you going to treat opportunity cost in your investment appraisal? An opportunity cost is treated as a negative, treated as a cash outflow, right? Which is tax deductible. Okay, right. It's a tax deductible expense in your investment appraisal. Let me give an example here so that we understand. Right, to undertake project ARA, right, a machine or any asset producing product Y will be required. Okay, right. In order for us to undertake project ARA, we have another project where we are producing product Y. So we are going to withdraw a machine from Y so that we produce we undertake project ARA. So what does that mean? It means that we are going to stop producing Y units. All right, the asset produces 15,000 units of Y, which earns a contribution of $10 per unit, a contribution of $10 per unit. So if we are now going to withdraw the machine from Y to R, it means that our lost revenue per year is 15,000. So on your operating cash flows after let me do this one quickly. Right, after you have laid down your years, year 0, 1, 2, 3, 4. Just an example here, right? After you've done that, you have your sales, variable costs, variable costs, you have your fixed costs that are relevant fixed costs down there, fixed costs, all right, costs. Right, after that, you then need to include opportunity cost before taxation. So your opportunity cost per year is you are going to put a negative value per year of 150,000. This is what we have lost from another project in order for us to pursue project project what? Project R. This is what we have. Any question? Any question? Right. Any question on relevant cash flows before I leave this item here? Right. You might also have a situation whereby the interest payments are there, right? So what is it that you need to know is that interest payments for interest payments are not included, right? They are not included. They are already included in the discount factor. So the discount factor itself means you are paying interest. That's what it means. If you have any interest payment amount for the purpose of calculating your NPV, you should not include that. Right, inflation is done. May I please have questions when it comes to inflation? Want now to look at incorporation of um, working capital in an investment appraisal. People are too quiet. Esther, any question? Molin? Are you guys still available, or I'm just talking to myself?
Yes, here we are available.
Yes,
We are
Santiago.
very busy.
Okay. That's okay. If you're understanding, then that's fine. Let us look at incorporation of working capital into investment appraisal. How are we going to incorporate our working capital? Let's have working capital. Right, incorporating working capital. All right. This now, what we need to understand is that the moment we are investing into a project, we need money to for day-to-day running activities of the organization. So what does that mean? In year 0, you are supposed to inject your working capital, but normally your working capital, all of your working capital should be then recovered in the final year. What does that mean? It means that you are going to withdraw whatever that you have invested in your project as working capital. So let's have a few notes here. I'm just going to put 3 lines. These are just 3 lines, and then we have an example on working capital. All right. Number 1, working capital is injected in advance. Working capital is injected in advance. So what does that mean? Advance, that is i.e. year 0, and this is negative. To inject is negative, right? Negative cash flow. You are going to, the initial amount is going to be invested in year 0. All right, that is the starting point. But at the end of the project, you then need to recover, recoup or withdraw all the working capital. So all working capital is withdrawn in the final year, right? Final year. So this is a cash inflow. In other words, this is a positive cash flow. So the two ends cash flow, the two ends of our working capital, that is what we do. Initial, right? The working capital that is required for year one, we inject in advance. Advance for year one is year 0. Advance for year 2 is year 1. Advance for year 3 is year 2. This is how we normally move on. But then at the end, we need to recover everything. Now, another note now from year 1, from year 1 to a year just before final year. Okay, I hope I'm making sense here. To assuming we have a project with 4 years, all right, year 0 covered, year 4 covered. So we want year 1, 2, and 3. That is year 1 to a year just before final year. So just before final year, that is year 5, 4, year 3. That is what we want to do here, right? Additional working capital is injected, right, if requirement exceeds what is already invested. All right, if we require more working capital than what we have, we just need to invest the additional component only, right? That is it. And it's not always the case that we need additional, right? Excess working capital is withdrawn. We are going to withdraw, is withdrawn if requirement is less than what is already invested. So if we require less working capital, we are going to withdraw the excess. But if we require more working capital, we just inject the additional amount. Question before I have an example. So I'm going to put 2. I'm going to have an example without inflation on working capital, and then we are going to have another example with inflation on working capital. We do that one. After we are done, then we try and look at a question that that we want to look at. All right, so we are going to do this question together. But for those guys who are doing AFM, I think I've sent through the question that you are supposed to be doing after this on investment appraisal. It's a past exam paper question with 15 marks. All right, a project with all right, a project requires the following amounts as working capital to support operations from year 1 to year 4. Let's put to year 5, right, for it to make more sense. So I'm going to have my year 1, 2, 3, 4, 5. So I have my 5 years here. Okay, this one needs to be All right, cash working capital. Right, in year 1, I require 375,000. In year 2, I require 289,000. In year 3, I require 425,000. In year 4, I require 384,000. In year 5, probably my project is about to end. I only require 250,000. Right, so these are the working capitals that I require for my project to run smoothly, right, from year 1 to the final year. So in most cases, this is quite easy to identify. The requirement is easy to identify. But what is required now is my working capital movement. Right, so I have to do a working on working capital movement. This is quite critical, right? So if I'm to do that, I know that I have to inject my working capital in advance. So I'm going to have year, I start from year 0 and then go to year 1 up to year 5, right, to work out my requirements here. All right. That's what we have. I'm trying to push everything so that it fits into the same page. All right, these are my years. Let me try and do my movement here. Movement. So my movement, I know that because I'm going to inject this as a negative, I'm going to put it into advance, right, minus 375. It's meant for year 1. So for year 0, I'm putting the requirement for year 1. Here, from year 1 to year 2, I'm going to put the difference. So what is the difference? Year 1 and year 2. I'm going to have year 1 minus year 2. I put it there. Additionally, 86. What does that mean? It means that in year 2, I need 289,000. So this is the amount that I have invested already, cumulative year 0 and year 1. You can see that this is the 289 that I require in year 2. I have injected that in year 1. Going to year 2, I also find the difference between year 2 and year 3. So what is the difference? Equals year 2 amount, right, equals this amount. I have to drop my pen here. Okay. Equals year 2 minus year 3. All right, I have 136. If I'm to add from year 0 to year 2, you can see that I have 429 to 425. This amount is invested. All right, for year 3, difference from year 3 and year 4, 41,000. If I add everything from year 0 to year 3, you can see that I have 384, right? 384 is invested. So for year 5, I'm going to have this minus that. I have 134. If I'm to add again from year 0 to year 4, you can see that I have 250. So in the final year, you just take what is there into the final year. Why? Because what we have invested is 250 cumulative, and this is what we have withdrawn in the final year. Question on that one? Any question? Any question? All right. If there is no question, let me just let me just try and give you a hint. On working capital, if there is no inflation, there is no harm, and you don't need to think here. You just do this, okay? Just come here, right? The first one, put it as a negative, minus this one, okay? And then from year one, you just, if you are in year one, just point year one minus year two, done. Just drag everything up to the final year, right? It calculates itself automatically. All right, assuming that we do have this, we still have this as the working capital requirement, but we are told that, right, inflation of inflation of 5% to be incorporated to be incorporated to maintain the purchasing power, all right, of our working capital. So what does that mean? It means that in our working capital, we need then to incorporate 5% inflation. So what do I need to do? First of all, I need to inflate my working capital. So I'm going to copy this one as it is, paste there, and then I'm going to call it real working capital. All right, real working capital. And then I'm going to have my nominal working capital. Yeah. Okay. So I want to incorporate 5% inflation. All right. So this is what happens. From the previous example here, you can see that working capital in year 0, in year 1, is supposed to be used in year 0. We are going to put it in advance. So what does that mean? It means that we do not inflate this one in year 0. Why? Because when we do our movement, we are going to put it in year 0. So this one, if you want to inflate it, you would rather do this because your inflation will be behind with 1 year. If you know that my inflation, I have to put my inflation behind by 1 year. If I'm to do that, 1.05, okay, to the power. So behind, before year 1, there is year 0. So I do that. All right, there is year 0. So if you inflate with year 0, it goes back to the original 375. With this one now, I'm going to have 1.05 to the power. We put it year 1 because our inflation is behind with 1 year. Why? Because we would want to drag these figures into advance. That's why we put inflation of the prior year multiplied by the amount there. So you drag, this is what you then do. So you see that even if I'm in year 5, inflation is for year 4. If I'm in year 4, inflation for year 3. Year 3, inflation for year 2. Year 2, inflation is for year 1. Year 1, inflation is for year 0. Right. If I'm done doing this, I can safely do my movement now. Movement from year 0. I have 0, then 1, 2, 5, like that. So after incorporating inflation, I can now do my movement. All right. So I'm going to drag, right, movement. I'm going to have this one dragged to year 0. That's why we inflated with year 0. And here the difference only this minus that. All right, and then we drag up to year 5. This is how we are going to incorporate inflation when we are dealing with working capital movement. All right, so we have managed to incorporate those 4 things into our investment appraisal. May I please have a question? May I please have a question? I have shared a question. I think with the AFM guys, I haven't shared that question with you. I may also try and share. The other question that I've given you is a question to look at. It is not really, it's not different from what we are doing. I want you to do that on your own, but well, for the meantime, let us practice using this question that I'm going to send. Right, anyone who hasn't received, anyone without the question, if you don't have a question, please just send me a message, or we can just use the question is I am beaming here, right? To the other class I have just dropped the question now, right? Confirm if once you have received the question. Right, here is the question that we want to look at. Right. All right. Confirm, guys, once you have received, so that we can move. Have you received the question, guys? Do I still have people here?
Yes, sir. I've received it.
All right, fine. Let's look at this question here. Question A, calculate the net present value of buying the new machine and comment on your findings. Work to the nearest thousand, that doesn't matter. Right, calculate the before tax return on capital employed, which is accounting rate of return based on the average investment, and comment on your findings. Discuss the strengths and weakness of internal rate of return in appraising capital investment. 7 marks. So let us go through this question together. Treco company, that's Treco. Treco company plans to buy a new machine to meet expected demand for a new product, which is product T. This means this machine will cost 250,000 and last for 4 years, at the end of which time it will be sold for 5,000. Treco company expects demand for product T to be as follows. So we have demand from year 1 to year 4 in terms of units. The selling price for product T is expected to be $12 per unit, and the variable cost of production is expected to be $7.80 per unit. Incremental annual fixed production overheads. So it means that these are incremental fixed costs. They are relevant. 25,000 per year will be incurred. Selling price and costs are all in current price terms. This means that the $12, $7.80 and the 25,000 that were given there are not inflated, they are in real terms. Selling price and costs are expected to be as to increase as follows: selling price 3% per year, variable cost of production 4% per year, fixed production overheads 6% per year. Other information: Treco company has a real cost of capital of 5.7% and pays tax at an annual rate of 30%, 1 year in arrears. It can claim capital allowances on a reducing balance, 25% reducing balance basis. General inflation is expected to be 5% per year. So the general inflation that we're given there is going to be used to inflate our cost of capital. Treco company has a target return on capital employed of 20%. Depreciation is charged on a straight line basis over the life of an asset. This is what we have. Okay, so let us do the computations. First of all, let's do this 13-mark question here, where we are supposed to calculate NPV. So first of all, I think what is wise is to start off doing all necessary workings, and then you compare your answer at once. Workings, right? So let's have our workings here. First, I think the working that is easy, working one, we want the nominal discount factor. Discount factor, our nominal discount factor here. If we can scroll back, we are told that the before, the real is 5.7, and inflation, which is general, 5% there. So I'm afraid to make use of my pen because I can't delete after this. All right, so I have this 5.7% to be inflated at general rate of 5%. All right, so that is key, that is critical there. Let me try to erase. All right, so I have created another problem again. Okay, that is not a problem. All right, so I'm going to have equals, open bracket, 5.1 plus 5.7% times, open bracket, 1 plus 5%, close bracket, minus 1. So my discount factor is going to be 10.99, which is 11% anyway. If you want to make use of 11%, that is still fine. Working 2, I want to calculate nominal, my nominal values. I want nominal values of selling price, variable cost, and fixed cost. Okay, so let me have my year somewhere here. Year 0, 1, 2, 3, 4. 4 years. Okay, selling price. So I can just put SP per unit. So my selling price per unit is $12. Because $12 multiplied by what? Let's see, the inflation for selling price is 3%. So I'm going to multiply 12 multiplied by open bracket 1.03 to the power year, close. So we have constant selling price. This should do automatically. So if I can do this, is 12 1.03 to the power 4 to the power 3 to the power 2 to the power 1. Our sales, remember, we don't sell in year 0, we start selling in year 1. Variable cost per unit, variable cost per unit, VC per unit, what is the variable cost per unit we are given? It is $7.80, inflation 4%. All right, so let's go there. Equals $7.80 times 1.04 to the power 1, close, enter, and then I drag up to here 4. That is what I have here. All right, question? So far so good? So far so good?
Yes.
All right, thank you. Let me remove this noise here. Okay, let's move on to inflate our fixed costs. Fixed costs are inflating at 6%, and the value of our fixed cost is what? 25,000. So we are going to inflate total FC equals 25,000 times open bracket 1.06 to the power 1, close. Right, let's compound that up to the end. This is what we have. All right, we have this. Right, we are done with our inflation. We have inflated everything here. Next working, I think we should now do our TAD. So to those, I'm going to present two methods of calculating NPV when we have tax allowable depreciation. Okay, all right. Next item, let's have working 3. Working 3 here. TAD. Working 3 TAD is equal to, I'm going to have my years. So we also need to check with regards to our tax, when is tax payable? That is very important. Our tax is said to be payable in arrears. Is that so? Right, 30% 1 year in arrears. So if tax is in arrears, it means that our presentation here, including the presentation when we do our NPV, we have to make use of 5 years to cater for the taxes. Okay, right. So I'm going to have a small table here. Right, what is my initial outlay? Right, initial amount is 320, if I'm not mistaken. So at 250,000, scrap 5. So initial is equal to 250, 1, 2, 3 in year 0. I'm going to put it as a positive value because I am going to calculate a positive benefit. All right, let's look at depreciation. 25%. It can claim capital allowances on a 25% reducing balance. All right, so what does that mean? A target what? That's okay. Depreciation is charged on the straight line basis. So this information down there is meant for accounting rate of return, not for NPV purposes. So for NPV purposes, we are going to use 25% reducing balance, and tax is 30%, 1 year in arrear. This is what we are going to do. I'm going to have my depreciation there. This is 25%. All right, equals 25% times this. All right, I can drag up to year 3 this working, so that when I do my my WDA, let me put WDA here. When I do my WDA, it does automatically this minus that. All right, and I go there, this minus that. All right, and finally in year 3, this minus that. I have this. Now in year 4, since my project is ending in year 4, I'm going to take this value. I put in year 4. All right. For depreciation now, I'm going to have 105 minus scrap 5,000. Done. This is what I have in the final year, and I calculate my TAD. Tax in arrears 30% equals 30% times year 1 depreciation. I drag up to year 5. Right, this is my TAD done. Question on this one? Question? All right. Let us then calculate NPV. NPV, that is working number 4. Working 4, net present value of the project. That's what we want to be looking at now. I have my years from year 0 up to year 5. All right. That's it. Let me just try and create a small table here. All right, so this is what I have, but well, I need to probably put my units on top there so that I'm not confusing myself. Sorry. All right, sorry about that. Let me put my units on top there so that I don't confuse myself by mixing figures with those that are not required. Let's look at our units. 35, 40, 50, 25. So we have 35,000 here, 35,000, 40,000. Is it 50,000? I'll just cross check again. Finally, 25,000. 35, 40, 50, 25. Right? 35, 40, 50, and 25. That's correct. So I'm going to put my units on top so that whenever I'm doing my additions, I'm not going to confuse myself with these units that I'm going to sell each year. All right. I'm going to just highlight my units there. All right. Since I have calculated, you can start off by, if you want to save time, you can calculate, you can start off by calculating total contribution. Yes. Munyarazi.
Sorry, sir, Maisa 250,000 now.
250,000. All right. Thank you.
Yes.
Okay. Thank you.
Okay.
All right. Let me just remove another 0. Thank you. All right. 25,000. I'm going to start off by calculating total contribution, which is wiser and it's faster that way, where I'm going to have equals, right, open bracket, my selling price per unit for year 1 minus my variable cost per unit year 1 times the units for year 1. If I can do that, my items are aligned, right? I can actually drag up to year 4. All the answers, right? My total contribution is there, right? This is quite faster than calculating sales, calculating variable costs, and then you want to add more computations. So I can just calculate my total contribution at once, then total fixed costs. So my fixed cost is a cash outflow equals minus the fixed cost that I inflated there, right? I drag up to year 4. Do I have anything else operationally? No. I'm going to have operating cash flow, So my operating cash flows, I'm going to add these two figures that I have here. These two only. I have this up to year 4. And then this is where taxation is going to come into play. My taxes in arrears equals minus 30% times cash flow for year 1. This is how we tax in arrears, and then we go to year 5. Right, so the operating side is done. I'm going to have my initial and scrap. Initial and scrap. My initial minus 250,000 in year 0. My scrap in year 5, in year 4 is 5,000. That's it. Initial and scrap done. And then I'm going to, we do not have working capital. We do not have working capital movement, but we have tax allowable depreciation starting again from year 2 equals the TAD that I have computed here up to year 5. That's it. Right, everything. This was quite a small, simple question to calculate. And then I can have my net cash flow here. Net cash flow, I'm going to add from operating cash flow down there, add everything, and I drag up to year 5. These are the operating cash flows, the net cash flows rather, that I want to tax. And then I put my discount factor. My discount factor, I have calculated it. I'm going to just reference to where 10.99% is. I put it there, and straight away I can calculate my NPV. I prefer this method, which is faster when it comes to NPV. All right. I'm going to do this so that I can also present it in another way so that you guys satisfied. Okay, because this one in year 0 we don't discount any value in year 0, so we just reference to that, and then we tell NPV, we type manually NPV open bracket, then discount factor comma, highlight rest of the values there, close, enter. That is our NPV that we have here. So 106,499.45 is the NPV. So Treco company, Treco Co should accept their investment as it results in net increase of 106 point this 499.45, right? The increase of net increase of that as it result in net increase of this in shareholders value. All right, in shareholders value. In other words, we are telling them to accept the investment because it is positive. This is the first way of you calculating your NPV. Right, let me have questions before I present another way. Simon, are you still there? I think you've asked.
Yes, sir. I'm connected.
You're connected. So I think if you are to answer questions on your paper, we now have to take into account the issue of losses, and we need to roll over our losses to reduce taxable profits in the next year. Is that what you wanted to ask?
Yeah. If you can just do a demonstration, because that part of taxation, I think for AFM it's a quite confusing part, especially for taxation.
All right, that's okay. I will make a presentation on that. I will just show you how we can
Okay, thank you, sir.
do that. Okay, so what we are going to do, suppose that this now are applicable mainly even to FM guys. You can make use of this. It is faster, straightforward. Again, I'm going to I'm going to have my table again, and I want to calculate NPV in another way, in a different way. Okay.
Hello, say.
There's
Yes.
there's
Yes.
Hello,
Yes, madam.
say.
Yes,
I,
madam.
I'm I'm lost on how you calculated discount factor. Sorry
The
to take you back.
discount factor.
Yeah, on working one on top there.
Oh, were you connected when we started? You were not.
Yes.
All right, so let me go there. My nominal discount factor, I've calculated it this way. Real cost of capital is 5.7%, and then general inflation is 5%. So in order for you to calculate that, you are going to say 1 plus I. So our I is interest. So equals open bracket 1 plus I close bracket times open bracket 1 plus H, then minus 1. So what does that mean? It means that the discount factor without inflation is 5%, 5.7%, and then general inflation is 5%. This is how we have calculated our nominal discount factor.
Okay, thank you, sir.
Okay, done. All right, I'm going to, well, for the purpose of us having this glued together, I'm going to copy everything here. I don't want to distort what we have calculated there. So I'm going to copy everything, and then I just go down, paste it somewhere there, where I'm going to produce another NPV. This one we've done, the upper part we are done. Right. For the purpose of us carrying over the tax credits in terms of a loss, because normally our taxation tax is charged mainly on profits, but for NPV purposes, we only consider the real cash flows only. So if we, oh, I have done this again. Let me try to, I don't know how best I can, all right, how best I can remove all these things. Okay, if they if it is right, it's okay. Hopefully you guys will be able to see. All right, now what I wanted to state here, instead of us having operating cash flows here, I can just have taxable profits. All right, taxable profit. I want you to take note of this taxable profit here. So what is it that I need to do? I need to input my depreciation, right? I'm going to subtract depreciation, not TID. I'm not going to calculate TID, right? I just need to calculate my depreciation. If I'm to, where is it? I'm going to ignore this line of TAD there. I'm going to input my depreciation amounts year 1, 2, 3, 4 only. So if that is the case, I'm going to have a negative equals minus my depreciation figures year 1, all right, year 1 up to year 4. I put my depreciation as I have calculated on my TAD table there. So I haven't calculated TAD. Guys, do you mind if I can close this and reopen? Because unless if you are seeing with the color red there, are you able to see? Or you are not even seeing it from your end? Are you seeing properly, guys?
Yeah,
Yes.
Okay, that's fine.
Yes, we are.
So what I'm going to do is this. After calculation of depreciation, I just need to determine my depreciation amount. So if I have my depreciation included there, it means that I'm no longer having a cash flow, but I now have my taxable profit. So if I do this, all right.
Is the lecture being recorded? I'd lost network about 20 minutes ago.
Yes, it is.
All right.
It is. All right. This is what we have here. And then I'm going to remove this. Right. So for the purpose of those who are doing AFM, after you have taxed your after you've calculated your tax, and then you need again to add back that depreciation. So you just input your depreciation. After inputting depreciation, you add it back as a positive value from year 1 to year 4. Right, can you see?
Yes, sir.
Can you see that my NPV is, I've removed the line of TAD from this computation? Can you see? TAD
Yes.
line is no longer there. So after all the relevant cash flows, I'm going to input my depreciation for tax purposes only. And then I have my taxable profit. I put my taxation, and then at the end, I know depreciation is not a relevant item. I add it back. Then if you can do that, you have saved yourself from calculating TAD. So you input your depreciation for tax purposes only. After taxation, you add it back. After that, then your NPV, if you can check this NPV that we have, by adding and removing depreciation, is still the same up to the last dot with this one, where we have calculated our TAD. Making sense? Right. That's all right. That is point number 1. Right. I'm going to explain another. So for those who are doing F9, this is sufficient enough. Right. There is a note that I want to explain to the other guys where there are losses. Right. When losses, that's number 1. Number 2, depreciation and scrap. So that's the thing that you need to know, right? So you note that when there are losses in any year, you have losses, you need to carry over the loss to the next year. I'm going to assume that, I think there's a guy who asked me a question. Let us assume that initial investment is 81,000, right? Scrap 1,000. That's it. Depreciation, straight line depreciation. That's it. Straight line depreciation. So this is what I'm going to explain in the next few minutes, right? I'm not going to make use of a full question, but I think you should be able to understand this. So treatment here, I'm going to have probably year 0, 1, 2, 3. Okay, I'm going to have 3 years only. All right, so I think in terms of you now, for the purpose of calculating your tax, right, assuming we are still on 30% tax, right, for the purpose of calculating tax, you are going to depreciate your asset in straight line. Okay, so what I'm going to do is that depreciation each year is going to be 81,000 divided by 3. So I'm going to have 27,000 depreciation per year. So this depreciation of 27,000 is the one that I'm going to input PANAPA. 27,000, 27,000, 27,000, 27,000. All right, up to the final, up to year 3 day. Right, and then I tax, assuming that taxable profit, and then right, assuming that we have taxed, and then let me just make use of this. All right, assuming that we have net, right, after tax, before tax rather, our before tax profits, right, before tax profits, in year 1 here we have a loss of minus $500. Okay, that is what we have, minus 500. And in year 2 we have 12,500 profits, 12,500, right? And here assuming we have 8,000 only in year 3, right? We have this as a scenario. After we have found our profits, we found out that in year 1 there is a loss. So this loss now is supposed to be rolled over to year 2, and it reduces the taxable profits for year 2. So your tax here is going to be 0 because the project yaita loss. But for year 2, we are not going to apply 30% to 12.5. Why? Because we had losses prior. So we are going to make a separate working PASASI, right? Year 2 taxable profits, right? Year 2 taxable profits here. What is it that we are going to do? Year 1 loss, right? We have 8,500, and then we have year 2 profit, we have 12,500. So year 2 taxable profits are going to be 12,000 after adding the 2. So for us to calculate tax for year 2, we are going to have 30% times what we have worked here. Although the profit is 12.5, just because we had a loss in the previous period, that needs to be rolled to the next. That is item number 1 that I think the guy had asked. Then, since we have treated depreciation straight away for tax purposes only, so you will be told that the scrap value of 1,000 is going to be taxed. What does that mean? It means after you are done with operating cash flows, when you do your investing side, where you are going to have initial, for example, I have my initial and scrap here. Initial and scrap, I have minus 81,000 is my initial, and scrap is 1,000 at the end. What do I need to do? I am going to write after that tax on scrap. So tax on scrap, I'm going to calculate my tax on scrap, assuming that my tax is rising in the same year. I'm going to multiply 30% times this. All right, So that is going to lie down here. Okay, so I think from what you have asked prior, this is the treatment. I'm not so sure if you still have any question, or if I have answered your question fully, or you still have some gray areas. Simon, is it Simon?
Thank you sir, for the demonstration. You have clarified the gray area I was having. So thank you, sir.
No, it's okay. You're welcome. All right. Ladies and gentlemen, may I please have questions? This is how we treat, or this is how we are supposed to be calculating our net present value, and this should bring us to close to an end of our presentation for today. But remember, we haven't done the advantages and disadvantages of NPV. Right, let us look at advantages and disadvantages of us looking at NPV, unless if you wanted us to then look at the other computational question that we haven't looked at here. We had A and B, so the B required us with 5 marks, required us to calculate accounting rate of return on before tax, because accounting rate of return is calculated using before tax cash flows. So probably we can do that first, and then we look at advantages and disadvantages of us having or using NPV. Right. If this was the question and you have been asked to calculate ARR, let us do that very quickly. Our ARR is the formula for accounting rate of return. ARR, we are going to have average profit before interest and tax divided by average investment, investment. And all these are supposed to be multiplied by 100%. I'm going to have multiplied by 100% here. Okay, so what do I need to do? I have to get all my net cash flows, net operating cash flow, for example. Let me go there. Net operating cash flows. Let me do this year up to year 4. Right, this is what we have. So operating cash flow, right, our operating cash flows, we have them. Let's have them from the first piece of computation. These are the operating cash flows that we have from year 1 up to year 4. We have this. All right, so depreciation, for the purpose of us calculating ARR here, we are told that the investment is going to have a straight line basis. So what does that mean? It means that our depreciation is equal. That does not matter anyway. So what we need to know is what is the total depreciation and what is the total cash flow. So our total operating cash flows, we just need to add them here, equals sum. We sum all of them, we put them here. These are 530,000. And total depreciation, our amount, we say depreciation initial less scrap minus scrap. This is how we calculate total depreciation. Our initial amount is 300. That was 250,000 minus scrap of 5,000, if I'm not mistaken. So total depreciation there is 240,000, and we have total profits. So total profits for the 4 years is equal to this minus the total depreciation that we have there. So our total profits are 285 994.94. Project has got how many years? Our project has got 4 years. So our average, all right, let me just skip a line. Right, I write here average profit. Right, our average profits now, we are going to have this divided by 4 because project has got 4 years. Average investment, the average investment from our previous session, we say initial 250,000 plus scrap 5,000 close divided by 2. This is how we find initial, and then ARR we are going to have 71 into this one, and then ARR is around 56%, which means that the project is acceptable as it has an ARR above the requirement. The requirement was just 20%. So this is how we were supposed to earn the 5 marks. Quite easy, quite straightforward. Any question on this ARR thing? Any question? If no further question, let us quickly look into advantages and disadvantages of using NPV method in appraising projects. Advantages. Right. I just want you guys to participate. Right. Advantage number one. Yes, guys, unmute yourself, participate so that it becomes interesting. What do you think is the first advantage? Yes, Rose without a Mary. You are there. I can see you. First advantage.
It takes into account the time value of money.
Thank you. Higher the wealth. Unlike IRR and ARR, they do not highlight the value that we get, but rather they just give us a percentage, which is the main advantage of NPV. Number 3, unlike payback, unlike payback, NPV, right, considers whole life of the project, right? That is NPV for you. If you are to use NPV to assess viability of a project, you are going to consider all cash flows of a project. So we might have a bias with payback period where you are supposed to be choosing a project that recovers the initial invested amount early, but then it does not mean that at the end of the project life, the project is going to give us much value. We do have other projects where in the initial years, they do not offer much, or probably they incur some losses, but eventually we are better off with those projects. So that is another advantage of us using the net present value. Number 4, unlike ARR, NPV considers relevant cash flows only. So with NPV, we are only going to consider what is relevant to us, and non-relevant cash flows are going to be discarded. Right, disadvantages. Right, disadvantages of NPV. Number 1, difficult to explain. Non-financial managers, difficult to explain to non-financial managers. Okay, right. It is difficult for us to explain to those people who don't understand numericals. Right. Number 2, another disadvantage. Number 2, cannot be used to compare projects with different capital base. So if we have projects that have different capital base or that do require different amounts as initial investments, we cannot compare. It is biased towards a project that gives higher NPV, and definitely a project that has got a high capital base is likely to give us higher NPV. So that is it for today, ladies and gentlemen. I'm opening this floor to questions, contributions, deductions, and etc. Any contribution? Any question?
Thank you, sir. You have covered
You
quite a number of issues that are examinable, especially the effect of inflation, effect of working capital. Those are key areas when doing NPV. Thank you, sir. You've delivered, especially on those areas.
you're welcome, say. You're welcome. So what is key is for us to do much practice on those questions, and I think I have highlighted what you guys are supposed to be doing. So for those who are doing FM, I will be sending more questions over and above the question that we have done today. Right. So you guys who are doing a FM, may you please look at this question. The Fenhest is a past exam paper question, and your NPV has got 15 marks. And everything that we have covered there, you'll find it there: incorporation of inflation, taxation, working capital movement, and etc. So AFM, with the FM guys, I'll send through more and more questions so that we can practice. So there's no reason for us not to be doing revision, because we have covered what is key for your exam. Any additional question before I say goodbye? Question?
Say, is it possible to get the recording at the earliest possible time?
The earliest possible time. Let me save it. Probably.
Hello, sir.
Yes, the earliest possible time that you can get it probably is around 11:30 today. 2 hours from now.
Thank you, sir.
You're welcome.
Okay. Okay, sir.
Yes, Tatenda. All right, bye, my guys. See you.
Okay, yeah, I wanted to ask about the recording since you have answered, because hey, Shamal. Yeah. Okay.
Right, I'll drop it in the class. I think around 11:30. 2 hours
Okay,
from now,
thank you, sir.
it will be ready.
Thank
Yeah.
you, sir. Thank you, sir.
Thank you.
Thank you. That will be
Have a good
appreciated.
night.
Okay, good night. Okay.
Yeah, it was things.
All right, Munya.